Are you interested in learning about investing but don't know where to start? Tired of working hard for your money but feeling like your money doesn't work hard for you? Well, welcome to the Apogee Wealth Podcast. I'm your host, Jonathan Nichols. Each week on this podcast, we break down the mindset, principles, and strategies that you can use to grow your wealth and live the life that you feel you were called to live. I hope you get a tremendous amount of benefit from this episode. Thanks for tuning in. I'm Jonathan Nichols, and this is my partner, Marcus Long of A Long Legacy. And we're going to be talking about multifamily investing state of the union. And so we're going to talk about, as full-time professional investors, some of what we're seeing in the market today, how it impacts investing, and then a little bit about some of our accomplishments and projects over the past year, as well as our plans for the year to come. Quick intro for me. My name is Jonathan Nichols. My wife Paula and I have been full-time real estate investors now for several years and started investing together after we got married about 8 years ago. First for a couple years in single family and then transitioned over to the multifamily syndication space. We live in Dallas, Fort Worth, Texas. Currently have about 100 million in assets under management and invest in deals across Texas and Oklahoma markets. My background is working as an aerospace engineer, so very analytical, enjoy the numbers part of this business. My wife, Paula, who is not with us, has a background in management consulting and is our COO and oversees a lot of our asset management and business executions. And with that, I'll hand it over to Marcus.
Yeah, thanks, Jonathan. I appreciate everybody being here tonight. And for those I haven't connected with, so as he said, Marcus Long, husband, father of two, got an 11 and 8-year-old kiddos. I spent a little over 21 years in the military before I transitioned out about 3 years ago. So living near Kansas City area, about 30 minutes south of Kansas City. I've been investing in real estate for a little over 20 years, primarily some single family and stuff like that for about 15 years before I transitioned my focus into multifamily 5 or 6 years ago when Jonathan and Paul and I started working together. So my degree's in finance from the University of Missouri. And yeah, so we've partnered with Jonathan, Paul and I partnered, as you'll see in a few minutes, here on quite a few deals. I'm a general partner on about 1,600 units, mostly in Texas and Oklahoma, a couple other exceptions to that, but many with them in those markets. Awesome. So yeah, tonight we're just gonna go through some stuff, as Jonathan said, and really talk a little bit about, some like interest rates, transactions, things like that, like economics that are impacting things and what we're looking at as we look at new acquisitions, our operations of existing properties, as well as like when to potentially exit properties and stuff as well. So, as we kind of like look at this kind of stuff, you'll see that there are, and you hear things on the news and in the media, whatnot. There are challenges in every economy and market, but with those challenges provide opportunities and stuff as well. And that's what we're trying to really look at is like where are the challenges, and how can we mitigate those to take advantage and capitalize of the opportunity. So here we'll just a quick look at the track record, and then Jonathan, Paul, and I have partnered on all but maybe one of these properties together over the last 5 years or so. And what we really want to highlight here is like the increase in NOI, right? Because as Jonathan mentioned, many of you probably have already invested in multifamily, or maybe you're thinking about it, and that's how we increase the value in the properties is by our ability to increase the net operating income. And so what we're sharing here is just kind of like when we acquired the property and our ability to increase the NOI over that time frame. And I'll highlight a couple that we'll jump into in a little bit more deeper in a few slides. Townhouse at the top, we just acquired, we closed on it about a week ago, so there's no data there. Jonathan will chat about. And then we'll also talk about CR Condos. That's towards the bottom there. We exited it about in October. And so that's one we had for 4 years. It's a full cycle deal. It was really successful, as well as Parkside Apartments, kind of towards the top there. We'll dive into that one a little bit. We acquired it in 2024 and just completed a refinance in which we're returning about 50% of the original capital to our investors. And so we'll dive into some details about those projects here in a few slides. With that, I'll turn it over to Jonathan.
Cool. So we'll jump into some of the more nitty-gritty of this presentation. And for those of you that are, maybe not as analytical or whatever, don't worry. We only have a few of these slides, but I think it's very informative for, talking about our business plans and what it is that we're trying to accomplish over the next year and where we see things. And so, first thing you have to talk about in any conversation with real estate today is interest rates. For those of you that maybe are not as attuned to interest rates in real estate, about 3 years ago, the Fed, almost 4 years ago, the Fed began to hike interest rates excessively in response to high inflation to combat that inflation. And so they raised rates at a historically rapid pace, which put a lot of stress on real estate deals, particularly real estate deals with floating rate debt, where the debt is not at a fixed interest rate, but rather changes as the interest rate changes. And so that's caused a lot of challenges that we'll talk through throughout the remainder of the presentation, but also has created some opportunities along the way. And so one of the first things I want to highlight that you may or may not be familiar with is that when we talk about interest rates, we could be talking about one of a couple different things. So on the chart on the left, you see the Fed funds rate. And so in the news, when you hear about the Fed cutting rates, raising rates, doing things with rates, this is the rates that they're talking about, right? It's the overnight lending rate between banks that the Fed has control over. And so some debt products that we use in multifamily, such as bank debt, bridge debt, are directly correlated with the Fed funds rate. In other words, when we get some relief from the Fed on their rate, we in turn can expect relief on these other types of debt products. However, the long-term fixed rate debt products, which we commonly refer to as agency, Freddie and Fannie, are not directly correlated to the Fed funds rate, but rather the Treasury markets. And so on the right, you see a chart of the 10-year Treasury, and you can tell that while it peaked, we'll call it the second half of 2023 at about 5% and has gone up and down since, we haven't seen the same steady drop in those rates that we have with the Fed's funds rates. And that's because the things that control these rates, namely the bond markets, are just simply separated from the Fed rates. And so as we look into 2026, we've had 3 rate cuts within the last few months. We're anticipating at least a couple more from the Fed over the next year. This may or may not result in lower rates on the 10-year Treasury. Now, personally, I believe that there are other things in play that will ultimately cause the 10-year Treasury to begin to drop and give more favorable rates to investors for this long-term fixed rate debt that we use, as well as your house mortgage rates that you're probably familiar with. But just understand that these are two different things. And so it just makes the puzzle that much more complicated as you're putting together your debt plan for acquisitions. Next chart that I want to talk about is actually one that I had thrown up on our State of the Union talk a year ago. And I thought it would be healthy to kind of review, particularly the piece of it that talks about the forecast and the 10-year Treasury yield. So if you'll notice, the shaded area starts on this chart beginning of 2025, when really, if it was today, it should be beginning of 2026. And so we can kind of say, hey, there were some projections that were made. Where are we today? And so the first thing I want to just look at are cap rates for multifamily, which is this light green line that you see right here. And the projection overall was that we would see them to slightly begin to recompress over the year 2025. And now in hindsight, what I can tell you is that I believe in general we've turned the curve on cap rates and recompressing on deals, but it's really dependent on the asset class that you're looking at as well as the particular market that you're in. So one of our full cycle deals that we'll be talking about here shortly was an A-class deal, a newer 2012 build deal. And what we're seeing in A-class right now is that these cap rates are very quickly recompressing. And also in strong markets such as Dallas-Fort Worth, which is one of the markets that obviously we like to buy in. However, other asset types such as C-class, that cap rate compression has been, I would say, much slower than what we see in this chart, although on deals that I'm looking at, we're beginning to see some amount of compression, once again, just depending on the specifics of the asset in the market. Now, looking below at the 10-year Treasury yield, we saw in our previous chart how it went down maybe slightly, but I would say overall this was probably a little bit more ambitious than what should have been expected from the 10-year Treasury over the last year. And so going into 2026, once again, I think as an investor, if you can plan on the Treasury being at or maybe just a hair lower than where it is today, you're probably set up for success. Whereas if you're banking on it going lower for a strong acquisition or a refinance, you may or may not be disappointed just depending on what happens. Now, let's I give you only bad news in these charts. If you look at the one on the right, you'll notice the gap between home mortgage to rent ratio. And this is really important for us as multifamily investors because it helps us understand the demand for our product. We essentially rent housing to individuals. And so the individual's other option besides renting from a multifamily owner is to go purchase their own home and pay a mortgage. And so when mortgages are at historically high levels, combined with a large gap between those mortgages and the rent prices, it will, of course, drive more individuals, particularly younger professionals, people that are maybe a little bit newer on their professional career to renting as opposed to buying a home. And so while this could change over the next year, right now this is something that's in our favor and really creating a lot of demand still for apartments. With that, I'll hand it back to you, Marcus.
Yeah, thanks. So, what we're looking at here on this chart on the left-hand side, um, it has like the multifamily transactions over the last 10 years, kind of broken down by quarter. And then on the right-hand side, it has distressed sale trends over the past few years. And so if you look at the chart on the left, the multifamily transactions, you'll notice, kind of a peak in, late 2021 into 2022 timeframe with the number of transactions that occurred during that time. And it's certainly dipped off since then. Um, Slight rise here recently. But as these two charts kind of relate, what I kind of want to highlight is that peak. And at that point in time, many of those, not all by any means, but there were a lot of variable rate bridge debt, that were used 2, 3 year ones. And I think that's what we see kind of here on the distressed sale trends, where you see that peak in 2024 timeframe, a little bit above 5%. So, when some of those were coming due or need to be refinanced, or the variable interest rate changed, that's where those many of those projects were in distress. And so it's certainly come down since then, but we're still, it's kind of stabilized higher than it was in previous years. And so because some of those are still, there might be some distress there, or even if they're at a longer, 5 year term, the ability to refinance or exit at similar interest rates is very different. And so while there's distress there for some, that also provides some opportunity for us as potential buyers to acquire things at a excellent basis as well. On the next slide, you'll see the same chart on the left-hand side, but what we have here on the right is upcoming multifamily maturities. So in a similar sense, even if many of the loans that we get are 5 or 6, 7 year terms, and you'll see those properties that were acquired in 21, 22 timeframe, those 5 year terms are will be coming due here in 2026, 2027. And so this is the number you kind of see similar to where those multifamily transactions peaked in that time frame. 5 years later, we have the maturities peaking in 2026, 2027. And so with that, those owners are going to be looking to, it's kind of a refinance wall, if you will. And when I say refinance, they have the option to refinance themselves, or new financing by a new owner acquiring it and stuff. So when we look at this data, there's just a lot of potential transactions or opportunities coming up for us as potential buyers. And, like economy and real estate, it's very cyclical. I think, we look at this, and we're probably at a high end there on the around 2022 timeframe, and it's hard for us to project exactly like where we are in that cycle. I don't want to say necessarily that we're at the bottom, but I think based on some of the trends that we observe and we see with transactions, with rent, and the values, we're probably, on the bottom curve of it, and hopefully moving up as we go into the next couple of years here. So I think uh, I think that's all on those two, Jonathan, unless you have something to add there.
No.
Awesome. So we're gonna move in. So that's a little bit about like some interest rate transactions, some things that we're looking at as owners, and we're gonna move into a couple case studies here a little bit. We'll talk a little bit about our 2025 strategy, focusing on analyzing properties in DFW and OKC, the refinance that I mentioned on our Lubbock property, and our exit of Sierra Condos in College Station in October. So the Parkside Apartments in Lubbock, we acquired this one in July of 2024. And I think one of the real highlights here, is the incredible basis that we acquired it at. And I think it speaks a lot to the knowledge of the submarket and the relationship, Jonathan had with the broker and the importance of that so that you're able to capitalize on those opportunities with the incredible basis when they become available. And so this one was a little bit different, business plan than many of our properties. A lot of them are more stabilized, 90+% occupied when we acquire them. This particular one was, below 70% occupancy, and so it required a lot of heavy lift, to get it above 90%, which is required essentially for agency debt, which we did within 4 months. And I think, from the time we acquired it until being above 90% occupancy, speaks a lot to the asset management efforts that Jonathan and Paula put. They actually, many of you guys that know them, they live in Arlington, and they went and essentially spent the first 4 months of our ownership in Lubbock, and so they were at the property probably 6 days a week. I would say at least. And so I think that says a lot. And this didn't come, we just finished this refinance in December 30th, actually, and we're getting ready to return 50% of the original capital to the investors. And so it wasn't by chance, it wasn't a market thing that completely helped that. It was a lot of effort and attention to detail in their asset management that allowed us to have that success. And then on this next one is our most recent full cycle exit. So Sierra Condos, 75 unit in College Station, Texas, one of the first properties that Jonathan and I and Paula worked on together. And it was a little bit different than many of our portfolio and stuff as well. It's a newer 2012 build, and so the business plan was less on the value add, very different than like Parkside and some other projects. A lot of the business plan was more operational efficiencies. And similarly, a lot of asset management, attention to detail to be able to implement those efficiencies and stuff as well. But really a great story here. We just exited it in October, and we weren't in a rush to sell it. We had about another year on our debt for it, but we had some offers that were brought to us, and we were really in a good position, to be able to analyze those offers, to look at them and accept them if they worked out, or to wait, longer and market the property. And ultimately, we were able to exit with 1.87 equity multiple in 4 years, which was higher than our 5-year projection of 1.82. With that, I'll turn it over to Jonathan to talk about our most recent acquisition.
Cool. So our last win for 2025, that's a bit of a cool story, is Townhouse Apartments. So when we went under contract to sell Sierra, for those of you that are more sophisticated investors, you know that the depreciation that we've taken on that project will be recaptured by the IRS unless we're able to find another project and do bonus depreciation against it in order to take write-offs and not pay those capital gains taxes. And so as soon as we went under contract on Sierra, I hit the ground running looking for deals. And it was challenging. I feel like I was in just about every market that we're in, talking to all the brokers. And for about 6 weeks, there's just nothing of interest. And then went to do a property tour one day with a broker that we have a great relationship with. And he, looked at a deal that we liked and probably would have put an offer on, but I don't know if it would have been competitive. And he just happened to say, hey, the seller has another deal down the street that's off market, but they would be interested in selling at the right price. And long story short, this was a Friday when we toured. Offer went in on Saturday, or the LOI, and we had the signed LOI by Tuesday morning. And so a lot of times people ask, like, what does it take to do this job or to be successful in acquisitions? And oftentimes it comes down to speed of just knowing what you're looking for, being ready to go and pull the trigger and make a decision very quickly if a good opportunity comes along the way. And so our going in cap rate on this project is 7%, actually probably even a little bit higher by the time we closed, which is phenomenal when you consider that the going cap rate for projects like this in Dallas are probably around 6%. And if you were to rewind about 3.5 years ago, this same property would have sold probably between 4% and 4.5% cap rate. And so essentially what that means in kind of layman's terms is we walked into about $1 million of equity day one on this project, as verified by the appraisal that we had done as a part of our acquisition. So this offered our Sierra investors an opportunity to reinvest, and many of them chose to take advantage of that and not have to worry about the taxes. One thing that was interesting about this project is it's a little bit lighter on the value add side, which I thought might be appealing to some of the Sierra investors, given the business plan that Marcus mentioned on that project. But the sell here is really the basis that we were purchasing at. And so, in order to take advantage of those tax benefits, we had to close by close of business on December 31st. And we had the wire from the lender that officially went to title 40 minutes before the wire cutoff time. And so, we worked very hard all fall, all of October, November, December to get this thing across the finish line. Agency debt right now is extremely difficult to close on. And we were able to make it a win for our investors literally at the last minute, which is just a testament to, I talked to our mortgage broker and some of our other team members after the close and was just like, hey, if one person on this team had not given the effort that they did, this would not have closed. And so just really shows what a team effort is and how everyone's contributions matter when it comes to things being right on the line and getting it done. And really proud of the team for getting this win. Um, we were able to secure 7-year fixed rate agency loan, which gave us at about a 5.5-ish% interest rate. So that's about 1.5% of positive leverage for those of you who are nerds, which results in, a lot more cash flow on the project than what we've seen in recent deals. So moving forward, we're now in 2026. Marcus and I, if you can't tell, are extremely optimistic about buying opportunities in this upcoming year and plan to do several deals over 2026, as of course we can find good ones to present to our investors. And so just want to kind of outline a little bit about our acquisition strategy. Much of it is the same as what it's historically been. I would say disciplined but aggressive approach. So discipline means like we have very specific boundaries and things that we're looking for, that we, do not want to cross in some situations. But aggressive means if we tour a deal on a Friday and we need to get an LOI out in 2 days and get it under contract, we're ready to go. Conservative underwriting. Obviously, every sponsor always says that they have conservative underwriting. But I would say that, looking at deals like Sierra, looking at deals like Parkside, we're able to pull 50% as opposed to 20% of investor capital out, shows that in general, we're hitting the mark when it comes to underwriting to reasonable assumptions. We're continuing to look in the strong markets of Dallas, Fort Worth, and Oklahoma City. Essentially, this is twofold. Obviously, Dallas is known to be one of the top, if not the top, multifamily markets in the nation. And this is our backyard. We live here. We can asset manage deals here. We have a good property manager here. And then Oklahoma City has been a market that has consistently performed very well for us and our investors. And so we intend to continue looking there. For those of you that are in deals with us there, you also know that we have a great property manager in that market as well that we're really proud to work with. Focusing more on B class properties, which I would categorize like 1985 or newer. I like that just because a lot of the maintenance tends to be easier on these properties, a little less risk when it comes to things like, sewer lines, electrical. And so those are the type of properties that we intend to look at. Obviously, the newer the better, as always. And, as typical, 100-ish unit deals that can be run by full-time on-site staff. And in order to do those deals, we're looking to partner with general partners who have, a proven track record and skin in the game along the way. So if you're on this call and perhaps you're not interested in being a limited partner or an investor in a deal, maybe this is something that would be of interest to you in this year. So, final thing I'll mention, property or seller distress resulting in discount. I get a lot of questions on this of like, what should we be looking for today? Like, should we be looking for deals that are, 50% occupied and about to be foreclosed on? Or should we be looking for things that are just, operationally deficient or CapEx, need some CapEx on them? And I would say the answer is all above. We're looking at deals on deal by deal basis, as Marcus highlighted. We've have experience and track record of executing on multiple different types of business plans. And so it really just depends on what makes sense for investors. So looking at distressed as well as, more stable deals like townhouse apartments. Won't spend a lot of time on this slide. You can definitely go back and take a look at it, but here's some of the highlights of the two markets that we're primarily interested in: Dallas, Fort Worth, Oklahoma City. And so, one final slide that's hopefully valuable to you as an investor is, as I mentioned at the beginning of this presentation, real estate, as with any investment, has inherent risk, and that will always be the case, no matter how good a job you do running deals or how poor of a job you do. There always will be inherent risk, but there are things that you can control that make you much more likely to be successful in this business. And so I just want to highlight a couple of those that may be useful to you on your investment journey. The first one is look at a large number of deals. This is really twofold. Number one, if you look at a large number of deals, you become an expert on deals in a given market or a given asset class. And so it really helps to sharpen your skills as an underwriter or acquisitions person. So that's something that we really focus on at Apogee. And then second, it just increases your odds of getting a better deal, right? You can afford, if you will, to offer lower prices and miss more deals because when you get one, it's going to be hopefully a home run deal. Second thing is solid broker relationships. I mentioned on Townhouse Apartments, this is a broker that I've been friends with for multiple years, and I was the only buyer that this individual broker was working with in order to secure this deal. We were actually competing against another broker. But the fact that we were able to sort of partner with him on the buyer side and get this locked up is really key. And so broker relationships are super important in this industry. It is the number one and only way that I have found our deals is through these relationships, and we continue to prioritize that. In fact, I will be heading to NMHC in just a couple weeks to network with brokers from all over the markets that we're in and look at potential deals for this year. We've already talked about conservative underwriting, so I won't belabor this point much further, but we try to make assumptions that are reasonable, but we believe easily achievable along the way. I do want to hone in on number four, which is strong asset management, and I have to give the credit for this to my lovely wife, Paula. As I mentioned, her former background was working as a management consultant, and now she does our asset management as well as is the COO of Apogee. And she really has an innate ability to work with staff, get the best out of them, manage projects, push people when necessary, and see the results that we need. And so I would say a lot of our success on Sierra is attributed to her and her, commitment to that project. And so that's really important in this business if you want to be successful. And then finally, flexible debt structures. Barring deals that are distressed and require bridge debt, such as Parkside, we really like long-term fixed rate debt, where we have options of getting out at various points across the business plan that are in the best interest of our investors. So just a couple quick slides and wrap up, and then we're going to open up for Q&A as promised. If you're here and you're an investor, whether you want to be active or passive, a few things you can do to get started. One, education. Myself and Marcus both have a ton of different resources to educate you, as well as are willing to have one-on-one conversations, or talk to you if you're interested in being a passive investor and want to learn more. Networking, very important in this business. And I'll actually be mentioning a networking opportunity here in a couple minutes that we're going to have in Dallas next month. And then finally, taking action. The one thing that differentiates people who are successful as investors versus those who are not are the people that will pull the trigger when they have an opportunity, take a step forward, and jump on it. And so, really encourage you, take the time to get educated, build your network, but then take that step forward in order to be successful. So here we have a couple different resources. If you're interested in being an active investor, I highly recommend joining some type of mentorship program or mastermind. I found that very valuable in my multifamily education. If you're interested in being a passive investor, I have several different resources here. Thanks for tuning into the Apogee Wealth Podcast. I certainly hope you found something valuable in this episode that you can take with you and apply to your own investing journey. If you found the show valuable, you can subscribe so you don't miss further episodes. And if you'd like to learn more about ourselves or our company, you can visit our website, www.apogeemfc.com. We have a ton of educational resources that I'm sure you'll find quite valuable. Until next time, happy investing.